Welcome to Tech Talk Tuesday. I'm your host, Karla, and with me is my fellow co-host and CMT, David Blake. It's Monday, August 26, 2024, and it was an exciting week in the stock market last week, but we do have some important things to look at moving forward. We do it mostly from a technical perspective. David, I hope that you had a great weekend. How are you doing today?
I did doing well. A little hot over the weekend, but not bad.
Definitely feeling the end of this August weather here as well.
It's gonna heat up in midweek too. It's supposed to get back in the high 90s again down here in Atlanta. So,
Oh, yep, same out here too. All right, well, let's get started by taking a look at last week's market activity, and then we'll see what's going on ahead.
Okay, well, last week we had another good week. Major indexes were up for a second week in a row, and they've now put together. 2 weeks ago was the best week of the year for stocks. And now this is the best 2 weeks the indexes have had for the year, and that's good. Now, the reason being, at this Jackson Hole Economic Symposium, Jerome Powell did signal that the FOMC would begin cutting rates in September. He did give us all clear button. And going into that, most investors were already kind of counting on that. It was kind of priced in the index. I was glad to see that we didn't get a sell the news type of reaction to that. Occasionally everybody thinks that when this happens, that this will be a good time for the market to go up. And it's a little bit nervous that maybe when he would say we're gonna start cutting rates, and some traders would say, well, it's already priced in, now we're out. But it didn't happen. That was good. We did have a little kind of choppy trading, some sideways action, but the markets did end up higher. Dow and S&P 500 and NASDAQ were all up about just under 1.5%. We did get a nice move in the small cap Russell 2000. Remember, they'll be one of the big benefactors of lower rates as the smaller companies begin to take on more debt and try to expand, that type of thing. And it was up 3.6%. So that was pretty good. We did see T-bills. The yield moved down a little bit. Nothing big. We did get below 4% again on the 2-year Treasury, and down to about 3.8% on the 10-year. That was those of the year. I think I got down to maybe 3.78, 3.79 midweek intraday or something like that. So that was good. The S&P 500 and the Dow were within a whisper of new highs during the week. In fact, intraday today, the Dow Jones had made a new high. We'll see how it ends up. We've had a couple, kind of a choppy trading today, which we'll go over because we're seeing NASDAQ diverge from small caps in the Dow, but we'll talk about that a little bit later. Anyway, so last week we did have REITs and consumer discretionary, materials and industrials lead the advance. Every sector was positive except for energy. And it was almost flat. There wasn't much going on with that. We did see a drop in crude oil prices during the week, and that was more on demand concerns from China. China's economy just they keep expecting things to go on, but their policies just become so growth restrictive that a lot of oil traders are a little bit nervous about that. Now, after that's been said, we did get a 3% jump in crude oil prices today, as tensions escalate in the Mideast. I'm actually kind of surprised that we're staying below $80 on oil. I do expect to see that probably move up a little bit, which will help the energy. In fact, the XLRE, the energy sector, is strongest sector today. We saw almost every sector of the ETFs make new highs or just almost make new highs last week, except for the technology, consumer discretionary, and the energy sectors. And they are underperforming on the longer run. And that's mainly because, we're seeing that rotation still out of the big cap tech stocks and some of the semiconductors and into the smaller caps. And that's causing, just a little bit of coming back to the middle for those sectors. They outperformed significantly on the early part of the year. And now we're seeing them kind of underperform, which should be expected. It's good.
Okay, and how is the technical condition of the market doing?
As far as the technical condition of the market goes, it's still strong. We are seeing the major averages keep upside momentum. That's good. We are also seeing key moving average support and resistance levels taken out. MACD, short-term trend gauge, is bullish. Momentum as measured by the 14-day RSI is strong. It's continuing to rise. We did get overbought towards the end of last week. We had the MarketEdge S&P short-range oscillator, the SLRE, that Kramer talks about that all the time on his show. Finished the week at 694. Normally that will cause some consolidation in the market. I think we were over 7 either Wednesday or Thursday on the SRO, and above 7 usually you do get a little bit of a pullback. I think we saw that happen on either Wednesday or Thursday. So we'll kind of watch that. Russell 2000 and Dow Jones Transportation Index, they outperformed last week. That's something we like to see.
And how is the underlying market breadth doing?
Underlying breadth was positive. We had the NYSE advanced decline line making new highs, several new highs last week, and that's considered a leading indicator of market direction. So that that just shows that there's more stocks under accumulation than are under distribution. So that's good. And then we also had the NASDAQ AD line, which isn't as important, but we did see it make its highest mark in 3 weeks. Now, another thing that we saw with the NASDAQ last week, we saw new highs outdo the lows, which shows a broadening leadership. That's something that was kind of strong, because we haven't seen the NASDAQ new highs outperform the new lows since I think there was like 1 or 2 weeks in early summer, and we're seeing the new highs expand. That's something you want to see as the market moves up. So that was good. We also, we had talked last week a little bit how we were starting to see more investors moving back to the middle. That they've been overly bullish for so long. Well, after we had this strong bounce off of the lows from the yen carry trade first week of August, brought in more bulls again. We saw the active investment managers increase their exposure to equities from about 56% to about 75%. I said they'd probably be net buyers over the next couple of weeks to try to get back, have more exposure to equities if the market's going to go much higher. Then we also saw retail bulls back to outnumbering the bears better than 2 to 1, according to the American Association of Individual Investors. So again, we'll start getting a little bit frothy right now, but we'll see what happens with that. So that's not too bad. As far as today goes, it was kind of we have T-bill auctions, not much on the earnings front. Again, I said we're seeing the NASDAQ diverge from the Dow Jones and the small caps. Part of that is what we have coming up for this week. Tomorrow, we're going to get the S&P CoreLogic release of the Case-Shiller Home Price Index for June, and we're also going to get pending home sales for July. That'll kind of give us another read on the housing market. Wednesday, after the close, NVIDIA reports quarterly earnings. That's kind of why you're seeing semiconductors today. People are kind of they're maybe taking some chips off the table. Part of that is because a lot's going to depend on their comments about customer interest in the artificial intelligence, how that's going. That's going to be pretty telling. As far as the options go, it looks like option traders are pricing in about a 9% move either up or down off of the earnings. So that's something to watch. We'll probably see a pretty volatile day on Wednesday. Okay, then on Friday, that's going to be another big day for the market. That's going to be the Personal Consumption Expenditures Price Index for July. That's the PCE. That's what Fed's favorite inflation gauge. As of right now, on the headline PCE, we're looking for 2.6. That's down a tenth from last year, 2.7. And on the core, we're looking for 2.7 for that's minus ex food and energy prices, and that's down a tenth of a percentage point from June also. So that probably be kind of one of the last inflationary numbers that the Fed will look at before the September FOMC. After that, we come back on the short week after the Labor Day holiday. We will get to see jobs report for August. And in fact, today, I forget which county he's from, but Fed President Daly was saying that they're happy with where the jobs are right now. They don't want to see much more softness in the jobs market. So we would see not the following week, not this week. If we see a surprise downside in jobs, that might be a little bit of a problem for the market. But that would probably just hint we could get a half a point cut at the FOMC meeting in rates rather than a quarter point. As of right now, it's pretty much still about 75%. They're looking at as a quarter point cut, which I think that's what they'll do unless we get a surprise in this PCE or the jobs this week.
Okay, well, lots to look forward to. I do have to ask though, so although it feels like the market did a 180 even from a technical perspective, but I know that we've been seeing certain key improvements to the technical condition of the market for at least the last 1 to 2 weeks, like you mentioned. What are the technical factors that supported bringing the market edge market posture to bullish and the CTI to not only positive but to a very strong value of 12, which is a whopping 18 notches from the prior week?
Well, okay, but the lows that we saw, these cycles have lengths. The A cycle is kind of a 6 week or 40 days. B cycle is 18 to 20 weeks, and or about 4.5 months. And the C cycle runs about 36 to 40 weeks, and it's about a 9 month. And as of the lows so they had all pretty much reached their time frames where they could get a new low was expected in the cycles. And we got that the first week of August when we had that big drop in the market. Then we had the bounce back. I said we were going bullish because the FLD was broken in price to the upside. That usually confirms that a low was in. And so in this case, we reset the A, B, and C cycles to bullish. And that's going to actually, we're going to stay bullish now into October. Usually when you reset, especially the B, C, or D, when you usually get a pretty good bounce off of that. And the fact that B and C cycles both were reset to a 1, you're expecting a pretty good lift in the market at that point. And that's why it came out to a 12. If the bottom was a -6, that's where you're expecting the cycles to bottom out and where they did. So that, like I say, as we reset, they start out at a much higher unit value. And that's why you're having the big move up from a 12. And we're going to actually stay 12, it looks like, into maybe about the second week of September. So I think, you may get some churning here the rest of the week with NVIDIA stuff and the PCE. But if the cycles are right, we should, again, that's a forecasting model. It's not a trend following model. Then it looks like maybe we get some choppy trading, but the market looks pretty good according to the cycles over here over the next several weeks.
And also, I noticed that the momentum index had a huge jump as well. We were at -4 for the prior week and then had a huge jump of 10 notches to get to the +6 value that we closed out on Friday. Is that fairly common to see such a huge jump in the momentum index?
It is when you see CTI change from a positive reading to a negative reading. And the reason for that is when we change to a bullish posture and the CTI is positive, then we start to look at all the different indexes, how much they jump or go higher off of the previous bottoms. In other words, if the Dow Jones is up 3%, August bottom, but the NASDAQ and the Russell and maybe the S&P 500, maybe the transports too, are maybe up 4 and 5 and 6%, then that will indicate that those will each get a point, and that means that the broader market is outperforming the Dow, and that is why you'll see that big 6 on a jump. That also the NYSE advanced decline line was positive that week, so all those add up to the numbers, and that's why we saw the big jump in the momentum index. Now, when we go to a bearish configuration, a negative configuration, or negative or bearish market posture, then we start looking at how far the indexes have moved from the top. In other words, the Dow's down 10%, the other indexes are only down like 4 or 5%. The momentum index might be a maybe -2 or -3. If the other indexes are down, like say 7 or 8%, the Dow's only down like 2 or 3%, then you're going to probably have a momentum index that gets closer to a -8, something like that. You're not going to see it in general, much lower than a -8 as far as momentum index goes. So that's why you're seeing those big jumps again, because as I said, as we reset the CTI week ending 8/16, the momentum index now we were coming from the bottoms in the first week of August, and we saw the broader market outperform the Dow, and that's why you had the big jump up to the 6.
Okay, that definitely makes sense. To me, before it felt like the floodgates open to the stock market and everyone's rushing in, but it makes sense that everything is interconnected. So
Yeah, in other words, you want to see, when we base the CTI configuration off of the Dow Jones. And when the other indexes are all outperforming the Dow, you're going to get a stronger momentum index. That means the broader market is outperforming the Dow, and that's bullish, very bullish. Now, if you have what they call when the generals are walking alone, and you have the Dow, it's going up, the other indexes are staying flat, then you're going to see, you could actually maybe even see a negative momentum index, even though the market posture is bullish.
Okay, yes, I actually remember that quote is also in my favorite book here, The MarketEdge Way. So if you
take them to the help out there, the managed thing, where they can actually read more about these. You can show them where it is, where they can read about how the different indicators are, and what we have in the different articles.
Oh, yes. So also love this section of our site as well. There's a lot of really informative articles here. So highly recommend going into those as well.
And then the second one right there, using cyclical analysis to determine intermediate term targets. That's something that they could look at. It talks about some of the cycles that we use, and after they've broken some resistance lines and that kind of stuff. So if they look around some of those tutorials, they'll get a better understanding of how the cycles are supposed to work, and then they can kind of follow along themselves.
Okay. I highly recommend that section. And then last thing that I wanted to do is I just wanted to take an updated look at the SPDR sectors, because I know that a lot of the sectors have been beaten down, but they have improved significantly, and the ones that were too hot are now at the bottom performance wise.
We are seeing rotation from out of the big cap tech and some of the semiconductors, that type of thing, and some like the Amazon, some of the Magnificent Seven, and because of that, you're seeing here at the very bottom, you have XLY and XLK, which the Magnificent Seven pretty much makes up those two sectors. And those are both a void right now. And that's just showing that you're seeing investors rotate out of those two sectors, and they're going into a little bit more cyclical sector like financials. And go ahead and take utilities, REITs, consumer staples. Those three are actually, when rates go down, those are high dividend type sectors, and you're going to see more of going to outperform. So that's good. Then healthcare is also kind of a defensive sector. Then you're getting your materials and your industrials and your financials. They're getting upgraded from up to a neutral, and they'll be getting upgraded to a long. And if you look at those, they're almost all of them are at or making new highs as this thing rolls over.
Okay.
And that's a sign that the market's gonna probably, it's got a few more weeks in here that we can, with the election coming up and stuff, it might have some choppy trading, but when you have all that many sectors making new highs, then you have to imagine most of the stocks in that sector are strong right now, and that should propel the market higher.
David, we are actually close to running out of time for this week, but is there anything else that you would like to add going forward?
I think we're good. We're getting ready to kind of we're kind of winding down on earnings, although, we'll get some market reaction from the video on Wednesday. And then the PCE on Friday is likely to, maybe shake some heads, especially if it comes in lower than what we're expecting, or if it goes the other way, that could move the market. And then we're going to have the long weekend, and generally the first week of September is kind of, it's kind of a little chop. Most of Wall Street's on vacation before they come back into the second week of September and start going again.
All right. Well, I think that wraps up this week's Tech Talk. Thank you again for all the helpful information, David. We do have to wrap up this week's Tech Talk Tuesday, but we want to thank you to all of our listeners, and we will catch you guys next week.